This is the Value Investor Podcast with Tracey Ryniec. All things value, all the time.
Welcome back, value investors. This is Tracey Ryniec, Zacks Value Strategist here. And as you know, we've been covering a lot of different topics here in 2025 in the value world, but one of you reached out and said, hey, what about doing some value stocks that pay big dividends? And I know many of you are always looking for the income side of things, as I am too. I like getting those checks rolling in. And some of you are heading into retirement or in retirement, so you like getting that extra income as well as the cheap stocks. So I've done two podcasts this week on the dividends. The first one was on the Zacks Market Edge. You can go see that on YouTube. Go to zacks.com/YouTube to watch that video. It's also on Apple Podcasts if you want to listen to it, but I do recommend watching the actual video because I do bring up the charts on that podcast now. And that one is called Top Stocks Paying Big Dividends. So similar idea, but I didn't search for value over there. But I wanted to bring it up because many of the stocks were actually value stocks. So at the end of that podcast, if you listen or watch it all the way to the end, you'll see I'm like, I'm not sure what I'm going to cover on the Value Investor podcast where I'm covering the same thing about dividends. But never fear, I did figure out some further value stocks to cover, but I am only going to do 3 stocks for this podcast because you have a bunch more in the Market Edge. So combined, you're getting basically, these are all pretty much all values. So you're getting 8 stocks this week that are paying these big, juicy dividends, as I like to call them. Now, for the value investor here, I mixed it up a little bit. So I still looked for Zacks number 1s and number 2s. Those are the strong buys and buys. We're in the middle of earnings season. There's a lot of earnings reports coming out, but that means a lot of changes to the Zacks rank. And these number 1s and number 2s are hopefully companies that have already reported. And the ones I looked at for this podcast, that was true. They've already reported, so we already are getting some of their numbers in, and the analysts are raising their earnings estimates. That's why we're getting the strong buys and buy stocks, which we would like to get along with our juicy dividends. We're also looking for value on this podcast. So I decided to use PE of less than 15, which is my go-to. You could look for dirt cheap ones, less than 10, but since we're combining it with the dividend plus the rank, I wanted to keep it a little bit wider, so I went with 15 or less. Then on the dividend, I also went a little bit wider than I did on the Market Edge podcast, where I looked for 4% and above. This one, I looked for 3% and above, just so I would make sure I got a bunch of newer names that weren't in that screen, even though we are looking only for value here. So I put all that into the Zacks screener, and I got 113 stocks. So that's quite a few. On the other screen, I got 86 without the value, but looking for 4% or higher. Now, some of the ones I picked out, let me look. They're all paying over 4%, actually, of the 3 that I picked. So we didn't go for any that were just in the 3 range, but there were some interesting stocks in the 3 range. Now, what was in this screen, which is very similar to what was in the screen for the Market Edge podcast, a lot of banks. They just mostly reported earnings now, and it was a good earnings season. The analysts have been a little bearish on the banks heading into 2025, and so they've been raising those estimates on them for this year. So the banks are looking better And so we've got to include at least one. I know that they've been an issue. Obviously, we just had a banking crisis. What was it, 2 years ago now? So it's been a little while since we had that, but not that long. Then we had the financial crisis in 2008, 2007, 2008 into 2009. And so a lot of you are leery about the banks. And we've seen also with the banks, the stocks haven't done all that well. We have been anticipating breakouts in the actual stock, and then that's not happening. But the things seem to be turning around a bit this year. I know I've said this numerous times. So, eventually I will be right. And I'll be like, I was right about the banks, but it's only taken me 5 or 6 years to be right about it. But I would be pleased and, somewhat surprised, but still pleased if 2025 was the year we finally are getting a turnaround in not just the share prices of the banks, but in the actual businesses, and that they are looking pretty good. So we'll get to the bank in a minute, because I'm going to start with agriculture on this podcast. They were not included in the Market Edge podcast, but there were some agriculture names on the list, and along with the REITs, I'm going to talk about one of those again. And remember, the REITs are real estate investment trusts. They are tasked with paying out what income they get in rents as landlords to you, the shareholder. So usually the dividends are somewhat larger on REITs, not always, but usually. And that's why they show up in a screen like this. And then we have banks, which are paying these higher dividends because the banks are still kind of depressed, but they are giving back to shareholders now after all these years. And then we also have some of the master limited partnerships, which many of you are familiar about, the MLPs, and those are like the pipeline guys. And many of you have invested in those over the years to get that steady stream of income, because they are moving around oil, natural gas, liquid natural gas, and those kinds of things around US and Canada. And that's a pretty steady business. I covered one of those in the Market Edge podcast, so go watch that podcast to get the pipeline. But we're going to start with agriculture, like I said here, and we're starting with Archer Daniels Midland. They are ticker ADM, supermarket to the world. Yes, I'm old and I remember those ads, but that is still how I remember them. So they're making a lot of nutrition products for humans and animals now. And that business has struggled in the last couple of years, but they have the Zacks #1 rank right now. The style scores look pretty good. They do have the A for value, so they are cheap as a value. D for growth, though, C for momentum, but a B overall score. So what is happening with them? I took a look at their fourth quarter results, and pretty much trade policy uncertainty plus uncertainty in the biofuels, just a weaker market fundamentals, they said, are all impacting. So earnings still not looking all that good on a year over year basis. But they gave a range of 4 to 475, and currently the analysts are at 456. But you're asking, well, how did they get a Zacks #1 rank if earnings still are kind of on the decline here and not that good? They have 2025, we have one estimate higher in the 30 days, but one is down in the last week. But 2026, one is also higher, nobody's down. So I guess the algorithm is looking at, the preponderance of a few more up there. And that's how we're getting the #1 rank. Now, remember, the rank doesn't necessarily mean earnings growth. Earnings are supposed to decline 3.8% this year in 2025, but rebounding 10% in 2026. So the analyst thinking this weakness. The trade policy uncertainty should be over by next year, let's hope. And so maybe, a little bit better business for them going into next year. They did, however, raise the dividend 2% last quarter. So there is that. Now, how about on the cheapness side? It is trading with a PE of 10.4. So that's pretty cheap on a PE level, well under the 15 we're looking for. Price to book is 1. Price to sales is 0.27. So that's really cheap. That's definitely classic value fundamentals there. And dividend, now that's the key one you're all been waiting for, right? You're waiting to see what we're getting. It's $2 a share for 4.2%. What did I say they were going to make? $4.56. So they're paying $2 out of that $4.56. It's pretty generous, but they're not in danger of being, under what they're paying out. And I have warned, and I warned on the Market Edge podcast too, if you are looking at the company and the dividend payout is more than what the income is coming in, that's a bad sign because that doesn't make much sense, right? Just, in general, if you were to ask anybody, hey, does this make sense to pay out more than you're making? No, it doesn't. Some companies, the dividend aristocrats will do things like that in order to keep the dividend because they've paid it for so many years. But it is a bad sign. And so you should be leery with stocks like that. And this one is not that for right now. Now, the last couple of years for ADM, the earnings have not been good. There's been just a lot of struggles on this ag side, especially with weather issues and other things. So earnings have been down in 2023. They're expected to be down in 2024, or they were down in 2024. And then now 2025 looking a little bit weak as well. But they did warn on that, and the shares are kind of reflecting it. They are at multiple year lows. Let me see, 1, 2, 3, 4. You got to go back to almost the start or the first year of the pandemic, end of 2020. The stock did rally during the pandemic because it sold off so sharply. I did buy it for the Zacks Value Investor portfolio in there in March, I believe March 2020. That was good timing. And then they soared up until 2022. But as those estimates, earnings started to be a bit unclear, we did sell out of the value investor. But shares have come down quite a bit. Looks like, it's like I said, at 4-year lows here. It is cheap, but still seeing a little bit of negative earnings growth here for this year. And they have said that they have a weaker market fundamentals and ongoing biofuels and trade policy uncertainty. So that's Archer Daniels Midland ADM, but you are going to get 4.2% yield for your patience. Okay, then we're going to switch it over to the REITs. This time I'm going for one that should be in favor right now because it has infrastructure in its name, and it's Brookfield Infrastructure Partners, ticker BIP. And why I'm saying it should be in favor is because it's in the key area, which is data centers, right? So they do data, utilities, midstream, anything that's big on infrastructure, $15 billion market cap. So they are a big cap, and they have reported earnings. They said 2025 was off to a great start. Their funds from operation was up 8% to $2.5 billion. They did deploy $2 billion into new investments in 2023, so over a year ago, which was accretive into 2024. So some of these investments are paying off. They did a 6% increase in the fourth quarter for the dividend compared to 2023. But as a REIT, again, they have to pay a certain amount out. So they're paying $1.62. right now, and that is yielding 4.95%. So pretty decent dividend here. These shares soared during the pandemic, then sold off in 22, 23, and now have been ticking higher, although they have pulled off of 2024 highs. But not the same kind of chart as what we see with ADM. Earnings picture looks a lot better than ADM's. It is more up and to the right with actual earnings growth. So 2025 expected to see 10.6% earnings growth. That's pretty nice, double digits for a REIT, which are usually slower growing. But when you're in these hot areas like data centers, then maybe you're growing a little bit faster, and they're also making these investments. One estimate is higher for Brookfield, which is a number 2 buy stock, and that's in the last week. One is higher. 2 are higher for 2026 in the last week. So analysts getting a little more bullish here in just the last week. That could be on the earnings reports as well. So 345 this year for earnings. 162 is what they're paying out right now. 380 for 2026. So that's a nice jump there. So Brookfield is in the REIT and equity trust / other category, which I also discovered a lot of these REITs are in when I did the Market Edge podcast. So this is kind of a grouping of others, including like infrastructure plays like Brookfield, but also some hotel REITs are over there. Some of the gambling, like casino REITs are over there. And remember, the REIT owns the real estate and you are like the landlord. You are getting those rents in. And that's why it's got the nice dividend. A lot of people looking for income like these REITs, but remember, REITs have a different tax structure and they're taxed differently. So consult your tax advisor on the tax implications of the REITs as well, because that is also out there. So Brookfield Infrastructure, ticker BIP. Oh, I didn't even say how cheap it was. That's kind of key. PE of just 9.5. So that is really cheap. Again, under 10. The other ADM just 10.4, but that's cheap too. Price to book 0.53. Price to sales 0.7. So all of these are pointing to really a lot of cheapness here with Brookfield Infrastructure Partners. It's a Zacks number 2. It is an A VGM style score. A for value, B for growth, C for momentum. So it does have that unusual higher growth style score that you don't always see with these high dividend payers. So BIP, again, is the ticker there. Okay, and then the third stock is going to be the bank. Since I talked about them so much in the open, of course, we're going to have one. Now, this one did, the screen gave us a lot of banks because they are now with the better Zacks ranks. I chose a different one than from the Market Edge. I did include one over there. That was a small cap bank. This one is a bigger regional bank. And so this one is much more well known. It is US Bank Corp, ticker USB. And it is the Zacks number 2. The style scores are not as good. B for value, F for growth, A for momentum, C on the VGM. But we did screen for value, so that is what we want. We're not expecting to necessarily get growth, but if we do, great. This one, like I said, it's a big cap, 74 billion market cap, and it's trading with a PE of 10.8. But we know with banks, that's not always a good indicator of cheapness. You should look at the price to book ratio. And the bank analysts always say you buy at 1 and you sell at 2. This one's a little pricier because it's been on a little bit of a run in 2024, but its price to book ratio is now at 1.4. So still on the lower side. It's not like it's 1.8, which is near the 2. So still some value even on the price to book ratio here. Did I say they're mentioned that they're in Minneapolis? They're Minneapolis big regional bank. Their last quarterly report was interesting, and I actually brought it up here because it doesn't really make sense for me to say what they said when we can just say what they said. So, because banks are a unique area, like a lot of REITs are too. So each bank has its own type of business and where its interests are. It does matter regionally a lot of times based on what is going on economically in that region. Or, say, for instance, you're a Western bank, you might have a lot more companies that are in technology. A Texas bank may have more energy exposure, that kind of thing. So Minneapolis is going to be pretty diverse, I would think, with what's going on up in that region of the country. But they did say that, things were pretty solid in this quarter for the fourth quarter. Now we're talking. They said, and I'm quoting here, non-interest income benefited from strong year-over-year growth in commercial products, as well as trust and investment management fees, as we're seeing the results of greater interconnectedness, and that's in quotes, play out in the form of deeper relationships, an enhanced product set, and broader distribution across the franchise. Credit quality remains stable, and our CET1 capital ratio ended the year at 10.6% as we balanced continued capital accretion with a modest initial share buyback this quarter. So I like the interconnectedness. It's sounds like to me, without looking deeper than what this says, that means, hey, someone has a savings account with us, maybe we get them a mortgage, or they have the mortgage with us, maybe we get them into some other accounts, a CD, or we get them into our wealth management, our investment management accounts, or our trusts. So that is key for any bank, really, and it means more business. So that's good to see. But I was also intrigued by this modest initial share buyback suddenly this quarter. So not only does it have the bigger dividend, but they're also doing a share buyback. So I'm liking that. And they initiated it in the third quarter. It is a $5 billion share buyback. And then they just started repurchasing in the fourth quarter. So we'll see how that plays out. But as an investor, of course, you're benefiting from the share buyback as well. They must see some value in these shares because they're willing to put your money into it, but the dividend is $2 a share right now, and that's yielding 4.2%. So that's pretty juicy, especially for, most of these banks. I have been looking around at the banks myself because I've noticed a decent number of them are over this 4% level now. So 2025 expected to make 438. And 2026 481. And again, the current dividend is paying out at $2. So they're well in that range. And earnings expected to be up 10% here in 2025 and another 10% in 2026. That's pretty good earnings growth, solid for these banks. Like I said, every time I'm looking at these, I'm surprised at what's happening with the earnings, that the analysts are raising, that they have the good Zacks rank now. That's a little different than what we've seen certainly since the banking crisis, but even before that, we haven't seen this kind of a little more enthusiasm for what's going on with the bank earnings. So, and the balance sheets are looking better here. So I'm liking what we're seeing. One estimate is up in the last 7 days for 2025. 6 are up in the last 30 days, and 4 are up in the last 30 days for 2026. A few estimates also down in the last 30 days for both years, 2 estimates for both, but that's just the analysts, getting in line. Maybe they were a little bit too bullish, a couple of them, and so they cut a few pennies there or something to get better in line. So again, the earnings are moving higher for this year at 438. They were 432 just 30 days ago. So they're moving in the right direction, I like to say. So that's opposite of ADM, which I talked about earlier in this podcast, which are moving lower there, even though the analysts are seemingly raising those estimates still. But year over year, those earnings are still expected to be lower. So that's something to keep in mind. I do like to see the rise in the earnings with the cheapness which this bank has, and that makes it even more attractive. So that's US Bank Corp, ticker USB. But I urge you to go look at the Market Edge podcast, where you'll get more stock picks, over 4% yields over there. But eight stock picks in 1 week, that's pretty good. Remember, keep sending me your ideas. I'm always looking for new topics. And as always, I'll be back next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.